What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is January 29th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to go ahead and dive in through a variety of different markets, from taking a look at cryptocurrencies to commodities like gold and silver, as well as energy markets and cannabis markets, to just kind of get a general overview of what's going on across the board in markets and still where my interest lies at the moment. So we've got a lot of things to discuss in the sense of price action and data right after our quick sponsor. Our sponsor for today's episode is TaxBit. The IRS recently released new forms in 2019 that require all taxpayers to attest to whether or not they traded cryptocurrencies, no matter if they made gains or losses. TaxBit automates your cryptocurrency taxes, enabling you to effortlessly track, calculate, and report your transactions. Easily connect your exchanges to securely sync your transactions and run them through TaxBit's tax engine. Generate your completed tax forms with a single click. Founded by tax attorneys and CPAs, TaxBit is the most trusted cryptocurrency tax solution. Get 10% off your tax plan today with a free trial using promo code DATADASH. Alrighty, so let's go ahead and spend some time to take a look across the board for cryptocurrency markets. As we can see, with Bitcoin up nearly 3% over the last 24 hours, the vast majority of cryptocurrencies are following as well. Most cryptocurrencies holding right about where Bitcoin is, anywhere between 2 to 4%, with some outliers to the top and also to the bottom. So again, keeping in line with Bitcoin and keeping in line with the trend that we talked about the other day, where Bitcoin has continued to pick up pace. Now, I want to go ahead and announce something really cool, guys. Not only are we going to take some time to just obviously look at Bitcoin, but we've actually got a functioning version of the SMS Indicator, which aggregates three of our favorite indicators. This is the Squeeze Momentum Indicator, the Stochastic RSI, and also the MACD. And we usually generally use it on the weekly and monthly time frame. Now, before I even dive into really how to read it or use it, I want to give a big shout out to my friend Sandeep, who's not only one of the subscribers to our newsletter, but through that, we actually got to meet, and he really loved this concept of, taking upon these three different indicators that I like to utilize on longer term time frames and aggregating it into one specific indicator. And he's put this together. He's the one who's actually programmed this, guys. Is basically just kind of taking the concept I've had and simplifying it into one indicator. So big props to Sandeep. He's a really awesome guy. And along with that, we're also going to have a Telegram link down below in the description. You guys are welcome to join. It's a channel where you guys can go ahead and test out the script yourself, provide feedback, make customized versions that might perform better, whatever it may be, right? So I want to get you guys involved in that. If any of you are interested, Sandeep would love to work with you guys on it as well. I want to make it a community effort. But long story short, as you guys probably know, those are three of my favorite indicators just to generally use on longer term time frames. And we can see how it generally works here on the chart. It's pretty simple. So anytime we trend at 3 points or above, this generally means that we're in a bullish scenario, right? We should get long on the position if we're following the indicator directly. Now, I'm not telling you guys to do that. I don't trade solely off the indicator. It just makes me more confident in knowing that the asset is rising in this case and it's in a bullish trend. Now, when we cross below 3 points, right, we go down to two or less in this case, right? So if it turns basically red on the week here, so going from here to here, this would be basically a change here in the trend from a 5 point down to a 2 point here, which is a pretty severe drop, and it's flashing a bearish signal. Then this would be a sign that we might want to step out of the market, right? Again, no guarantee, but it just shows us that there's a weakness in the trend, right? After multiple months of being green, after we flipped back over here in December of 2018 and rode the trend for a long period of time on Bitcoin, we can see that it was probably time for a correction of some sort. And it would have kept us out, except for maybe a few anomalies, like right here, for example, in November, from getting into any serious positions, right? So again, that's the key thing to keep in mind, guys. It's something to add into your suite if you want to use indicators. And what's nice is it doesn't take up three different indicator slots on your chart. It puts it all into one. Now, the only downside is that you're not getting a detailed report on what we're getting points out of in this sense. Like, right, for example, we provide 2 points to the Stochastic RSI and 2 points to the MACD. So in this case, you're not 100% certain which ones you're getting points from. But all in all, it doesn't really matter. Our general rule set is if there's 3 or more points in this case, and the more points it goes up higher, the more confident we can be that the trend is strong, right? So I've generally used this, in my opinion, to generally find when momentum is going to be cut out for some time. So for Bitcoin here, for example, the indicator didn't really, outside of one anomaly, really flash for a long time. And during this period of time, I could have taken out a lot of my positions and gone and traded on other markets that were trending at the time. So it is really good on these long-term timeframes to kind of signal whether or not you're in a market that's trending on a weekly basis, right? So that's the general kind of thesis here. Or you could also use it to the short side if you wanted to short markets as well. But again, don't just trade off solely off the indicator. Now, in the sense of crypto markets right now, again, guys, we're right on pace for where we should be. We've already talked a lot, and I don't want to kind of rehash it. We've talked a lot about the data science models. We are exactly where we need to be right now for this cycle. We've fallen onto support here, much like we did back over here in 2019 on the logarithmic curve, and we're starting to turn up. We're up 46% in the last 6 weeks here, guys. This is really solid price action for Bitcoin after we had a nice solid bottom here. Really what could be said is a double or triple bottom in the sense of price over a multi-week period. And outside of that as well, we've got a lot of ground to recover here, all the way up towards 14,000 and hopefully towards 20,000 as we go into the next couple of months here. But again, having events coming up, indicators flashing good, price found support exactly where it needed to be. We had one of the more severe corrections we've had in the past, so I think we're going to get a pretty significant rally afterwards. Things are checking out fine. Right? Don't look at the daily, don't look at the time frame, look at these longer term periods of time. And when you zoom out, it starts to become very, very clear here, right? What we're looking at, right? We're continuing it on the channel here, guys. It's just a little bit of an extended correction after a pretty stark rally here in one of the largest scales of market that we've seen for cryptocurrencies. So let's go ahead here, talk about gold, get another use case of the SMS here, right? We can see doing very good at picking out these trends here on gold between our three indicators. But the major thing I'm looking for here with gold markets as well as silver, as much as I'm really optimistic about these markets, I love that we're setting, for example, on these longer term time frames, higher lows, and we've started to really pick up pace here and really start to formulate a bullish trend. Right? I'm not FOMOing into this. Most of my hedging position is in cryptocurrencies, but I will say I'm definitely looking a lot more at gold and silver miners to really ride out this wave. It is always, I think, decent as well in a well-diversified portfolio. Again, you guys might not determine if this is good for yourself. Again, it's not financial advice, but I always recommend having a little bit of physical as well. I think that's just good. That's like your kind of insurance policy if things really do go bust. But there's nothing wrong with trading papers or futures or just basically doing something that's going to give you the price exposure. But bear in mind, if things really do go south, you're not going to have ownership of that. So that's the difference between owning physical. It's not as easy and liquid to trade, and there is some shipping costs, but it's like, I think it's worth to have it physical. In the sense of, and that's also with the minor stocks as well, just to be fair. So that's why it's always recommended you have a physical position of some sort. That's what I was forgetting to say. But you can see here, right, on the gold chart, and then also on silver, right? Gold and silver. Oh, we don't want to pull up the gold to silver ratio. We just want to look at silver. Gold and silver doing fine. Still setting higher lows here. I want to see a low set here around $17 per ounce. I don't want to see it going any lower because in this case, we want to keep up with this trend here of setting higher lows and then eventually really setting higher highs, right? Which we're still seeing a lower high here. So that's not a good indicative sign of a trend reversal to the upside. So even though we know we're still seeing a little bit of stagnation here where silver and gold have not really fully taken off yet, the thing I always try to stress to people is ratios, okay? Ratios are so important here, guys. As a macro trader, I've talked about this on the channel before, but as a macro trader, it's one of my favorite things to do because for me, I rarely have my money in cash. If there's no good opportunities, I don't have my money in cash. Sorry, if there's no good opportunities, I will have my money in cash. But if there are opportunities out there, I want to get a yield. I want to grow my capital. Plain and simple. Right? I want to beat out inflation at a minimum. And in the case here of using ratios, for example, like silver to the S&P 500, we can actually see very clearly that as much noise as there is in equity markets, and as much as there are some pretty stark jumps and drops, and not a crazy rally we've seen yet in gold and silver are still outpacing equities for the last year and a half. Ever since back here and the summer of 2018, we have seen commodities such as silver and gold setting higher lows when compared to a ratio of the S&P 500. You can do the exact same thing with the NASDAQ, whether it be for gold or silver. Same exact trend here where we're setting higher lows. And the cool thing about it that I think is very imperative, the reason why I use these ratios is you can see back here, back in the 2000s, we can see here that silver and gold, we'll take a look at gold in just a moment, had the same exact trend of higher lows, giving us a signal that it was better to be positioned in silver versus the S&P 500. And that's the whole point of the ratios. It doesn't mean that it's going to go up in the multiple of this ratio of a 10x in this case. What I'm saying is, basically, it outperformed equities to a 10x in this case, right? If we came from down here at 0.003 in the ratio all the way up to 0.03, we did a 10x in this case. It means that maybe as equities were going down, commodities were going up, or even when equities were going up, commodities were still going faster and higher. So the whole goal here is to not only view it in the sense we want to be holding something that's setting higher lows to that other asset and gives us a good amount of room for a future rally to occur, but bearing in mind that future rally and that future outperformance, we need to have a pretty long time horizon with most markets, guys. I think cryptocurrencies are the exception, working with 3 to 4 year cycles. But in the case of larger markets that are a little less risky, like commodities versus equities, in this case, we're looking at a near 8 to 12 year cycle in this case, where, for example, back here, right, we set the final low for silver to equities back here in 2000 and set the highs up here in 2011. It was a nearly 10 to 11 year cycle. Outside of that as well, we also had a bear market down here to the absolute low of silver compared to the S&P 500. That was easily a 7 to 8 year cycle. So we're talking about very long periods of time here, and you need to have that kind of time horizon when you're making these investments. If you're going to try to trade the daily time frame, go ahead and do it. I mean, but that's not what we're looking at, guys. Like we're here to find easy opportunities where on a yearly basis or on a multi-year basis, we can multiply our capital and not have to stress about it. We have our time frames in mind. We have our vision. We know exactly what we're looking for, right? And this is just generally what I did here is I copied the price action of silver here back in the past and just dragged it over, right? Now, I'm not saying it's going to act exactly like this. It might be a little bit ahead of time. It might take a little bit longer. You need to accept those things when you're building these positions, but to have that general kind of median time frame, understanding that this is going to be going well in, this is as we're talking about 10-year cycles, roughly speaking, you know, we're talking about going into the mid to late 2020s, right? So just something to bring up here, guys, that I think is very important. We can do the same here, as I mentioned. Take a look at gold. Gold's actually been doing a little bit better to the S&P 500. It's building a little more clear of a technical pattern, similar to what we did back here in 2003 through 2005. We've been building a multi-year bullish flag, or excuse me, not bullish flag, ascending triangle in this case with higher lows and a level of resistance. And one thing we're going to do is we're going to have a breakout here in the coming months. We're going to come down, make support here in 2020, and then we'll start really picking up. But again, time frames matter. And that's basically what we do. We copy the price action from what happened over here. It's not going to happen exactly the same, but we will see some similarities in this case. Hopefully, a general uptrend is what we're looking for. So I hope you guys enjoy those components here in the sense precious metals. Definitely my kind of like tie for my second market where I'd want to have exposure outside of cryptocurrencies. But who's in tie for second place right now? Well, that's cannabis stocks. And I have been very patient on this industry. I've been tracking it for a very long time before the crazy cannabis bull run we had back in 2017 and 2018. But taking that in mind, I want to go ahead and talk about the next cycle coming up, because in the United States, which is really probably the next target audience to get excited about for hopefully having federal legalization of cannabis, we have an election season coming up. And not to mention as well, you have potential maybe for European markets down the line and stuff. There's a lot of potential for things to start to change outside of just Canada and for the industry to grow. But taking into perspective here about the speculative waves, I will look for price here to really get confident on entering into any position, right? Those waves will come, right? But we don't want to rush it, and we also don't want to be too late to the party. The general thing we want to look for here is for a trend. We want to make sure that we are having higher lows and higher highs, right? Well, you could generally say here that we have had slightly higher lows, right? And this is in the MJ ETF. We also have, funny enough, the YOLO ETF, you only live once ETF, and then the THCX ETF. So they're really tailoring this to my age group, aren't they? But anyways, that's besides the point, right? The major thing I want to talk about here is we discussed with the cannabis rally we had back here in early January. Every single rally here, guys, that cannabis markets get, they fade off, all right? We see a matching amount of sell side volume, price declines. Anytime there's a bolster in equities for cannabis, people exit. They take that opportunity to gain back some on their losses. And that's the really like tragic thing right here. It's just making me a little bit cautious, right? I think we're very much towards the bottom here in cannabis markets. I think if anything, we have one more leg down to go. But you know, generally speaking, if you can't stomach those shifts, right? I would wait patiently for a trend. Or if you can't stomach waiting for a while and holding on to it and possibly not getting much of a yield for the next few months, right? That's the things that I would say to consider if you're going to buy cannabis stocks. Again, can't recommend you guys do anything. I don't own any positions right now in cannabis equities. I will let you guys know when I do, though. And I'm definitely keeping an eye on it. Again, it's in my second place here. It's tied with gold and silver for positions to go into the next year. I think it's one of the few equity sectors that actually has room to really grow over the next few years. Right? There's not too many. Tech is extremely overextended. As much as I'm a big tech guy, I'm very much into emerging technologies. But you know, whether it be hardware, software, it's just crazy valued right now with the excessive amount of stock buybacks and dividends. When those dry up, it's going to be a pretty rude awakening. And I think that that's a sector that's going to move broadly with the overall equity market. All right. So anyways, last thing here that I want to talk about outside of this, I mean, we could take a look at the individual cannabis stocks. Kronos, for example, it's almost a mirror reflection in a lot of cases. CGC, one of the stronger players that's actually setting higher lows. Tilray, fading off a lot of its gains. VFF, right back down to the lows. Let's see, we got Charlotte's Web as well. Again, some of these are holding up decently well, but there's not a clear trend across the board, which is what you want for a trend reversal. Some of them fading right back down. Okay. Last thing I want to talk about is the energy sector. Now, we usually don't talk about energy too much on the channel. We have recently talked about how oil and natural gas have reached an overabundance in supply, and we are seeing a longer-term macro shift where people in the United States are consuming less. And that's going to be a counter to some of the global growth and demand for oil and natural gas. Not to mention, as we talked about, you have a supply glut. You have the United States being the largest producer in the world of crude oil, and now being a net exporter, big shift from the last few decades. And then you've also got a ton of other countries, Saudi Aramco and stuff that just IPO. There's a lot of overproduction right now between the OPEC nations, between countries like Russia, countries like the United States that are doing big amounts of oil exports. So right now, we can see that being reflected in the price. We're taking a look at a monthly chart here. You can just see here, whether you're looking at the logarithmic chart or the standard chart, we can see here that we are right on the brink of either a make or break moment for commodity stocks. For generally, because the XLE ETF is basically going to be your oil, natural gas kind of stocks, but it also has a little bit of a combination of renewables. So we could either pick up here, right? We got to start moving soon, or we are about to break down on a parabolic line of support here that has been supporting energy stocks for a very long period of time. And quite frankly, I really don't know if it's going to be able to hold this line of support and that we might start to see a breakdown lower. The reason I say that is taking a look at a lot of the major commodity prices. We take a look at CL1, right? This is crude oil futures. We can see here trading at $53 a barrel. Take a look here on the daily, guys. The fade on the rally has been real. We lost every bit of gains we had since down here back at the lows at 52. And we actually talked about this back in the fall. We were saying that the supply and the divergence in price with no change in demand is unjustified in the sense of price. Like the price was not justified with any serious changes in supply and demand. There was too much of a glut, and markets corrected. And this is not just the case with crude oil, right? I mean, we've been talking again about energy being in a pretty make or break moment for some time. I generally said if we broke above this line of resistance that's been holding crude oil down since back in 2008, then in this case, I would get really bullish on energy stocks. I would start to look, for some opportunities for drillers and refiners and distributors, all kinds of different areas of the sector. But we haven't gotten that, and it's holding it's holding by a thread here on the 50-month. This is a very key moving average on the longer term time frame for major commodity prices. And we'll see that not only here with crude oil, but along with that as well with natural gas. So we can see here, this is something I'll share with you guys, something we usually put in the newsletter, but we always talk about with natural gas on the longer term time frame. Anytime we get a significant break below the 50-month here, the 50-month moving average, we tend to have a long-term correction, right? Back here, when nat gas is going from $7.99 per CFD, down to $2 down here, And then also over here as well, from 369 down to 147. And we've pointed this out all the way back here since 2018, 2019, that if we were to break down past this line, we'd come down here to the bottom end of the channel, which is going to be about $1 per CFD for natural gas. A lot of people are going to lose a ton of money producing at these levels. So I think we'll get a resurgence here, but what's going to happen is it's going to lead to a very, very bloody period right now for the next few months for a lot of these commodity producers, for those who are heavily exposed to natural gas production in the United States, where the cost is a little bit higher, in countries like Russia, where the cost is kind of midway, and it's also going to still be a burden for those who might still turn a profit, such as OPEC countries like Saudi Arabia and a few other areas where they can operate on very low costs, but it's still going to cut into their margins, so it's going to mean less cash flow either way. So yeah, I would say until we reach down towards this bottom here, guys, I'm not touching energy stocks, but it is an interest of mine, not only in the sense of commodity producers, but also in the sense of renewables, from solar to wind, and also, as we've talked about here on the channel, uranium. And this is, I think it's going to line up pretty good here, because with the declining demand and the glutton supply and the cheap prices here for commodities, I think it's going to play into this kind of phase of a recession here over the next year or two, where we can find a lot of value in these companies. And I also think we'll be able to find some value in URA. Now, some of you have asked about uranium. Let's go ahead and turn off the moving average here, just to kind of focus on the price. We've been basically in a descending wedge here. Now, good news is, descending wedges usually end up being bullish patterns, and they usually lead to a breakout. Bad news is right now is that we're far away from reaching the narrow end of this, so it could go on for a while. And this really has to do with the lack of continuation and serious cuts for uranium, and we're still waiting to see some of the demand from Japan and other countries starting to come in to compensate for that supply. So we're going to be keeping an eye on that. And if we see any kind of serious price moves here, or maybe on some of our favorite stocks like UEC, is some of the individual uranium producers, or Cameco, in this case, then we'll start to definitely look at the uranium sector again. But until I see a trend, guys, I don't touch it, right? I know I talked about uranium markets just like a lot of other markets before, but again, always want to present the idea that we have to wait in this case for a real significant trend to formulate, especially in these longer term markets. I mean, why rush it? It's going to take a while to really kind of take in these gains. They're not going to happen overnight like cryptocurrencies, because we're talking about much larger markets of scale. Why not be patient and wait for a clear signal? That's what I always say. But anyways, that's it for the video, guys. I know we dove through a lot of different things, from commodities and energy to cannabis, precious metals like gold and silver, and also taking a look at our favorite market, cryptocurrencies. So in summary, my top market where I'm most exposed right now is personally cryptocurrencies. There's nothing wrong with having a smaller percentage of your portfolio. In fact, I'd say for the vast majority of people, it's probably not good to have an overt exposure to crypto. But again, I'm pretty much on the younger end of things. I can take a little bit of risk, and I'm very well knowledgeable in this market. Some of you have asked as well. There's one thing I just wanted to mention here. Some people had asked, how do you really set stops here for positions if you're keeping things in cold storage? It's a very good question. So sadly, it's kind of one of the downfalls of cryptocurrencies right now if you wanted to use centralized exchanges. The sad thing is you have to keep some of them, your positions on there if you want to use stop losses, and accept that, you might be holding some that, if things were to go down to zero, for example, yeah, some of your assets might go down to zero. But there is actually a solution. If you're trading any kind of ERC20 tokens or Ethereum, you could actually set orders on a variety of DEXs. So you guys can actually use non-custodial platforms that are either saving your funds in a smart contract, or in this case, basically decentralized exchanges like Kyber or DYDX that give you some exposure to be able to get out in this case and set some form of stops. Again, we're still seeing this space kind of evolve, and I think there's actually probably more risk of something going wrong with a DEX like that than having your money on a centralized exchange and something going wrong, right? So again, you have to kind of weigh it, distribute yourself, determine what's best for you, but explore some of those options. I think it's definitely worth looking into it if you're big on the vision of decentralization like myself. That being said, though, guys, that's it for the video. I've rambled on clearly enough. My favorite market, cryptocurrencies. Second favorite is tied between precious metals and cannabis markets. And then third, outside of that as well, thing that I'm going to be looking to pick up on big, because energy has been cheap for the last decade, is natural gas, probably some oil stocks and stuff if there really is a possible resurgence. But really, I'm going to be looking at a lot of the renewable sources, uranium, also looking at not just uranium, but also taking a look at wind and solar as well. So just kind of a nice broad energy portfolio would be what I'd be interested in, about 20 to 25% split between each of those different industries. So anyways, I hope you all enjoyed the video. If you like it, drop a like. Bit of a ramble sesh today, and I hope you guys are having a great day wherever you are. Stay tuned.